Hello and welcome back to our finance mini-series. I'm Dr. Robert Clark, and today's video will touch upon the basics of the principles of cost of capital. The cost of capital is quite a fundamental concept in finance, and it refers to the minimum return that a company must earn on its operations, on its investments, in order to satisfy its investors and lenders. At a basic level, the cost of capital is the weighted average of the costs of the various sources of funding that a company uses to finance itself, to finance its operations. This includes the whole of the capital structure, from equity through debt up through the pyramid. So we can start by touching upon equity. What equity represents is the ownership interest that shareholders have within a company. And the cost of equity is a hypothetical interest rate to determine the value that those investors expect from their investment. There's various models that we use within finance to work out this cost of equity, and one of the most common is the capital asset pricing model, abbreviated as CAPM. The CAPM model entails a variety of inputs, such as the risk-free rate, which we have discussed in a previous video, the risk premium that investors demand, and the company's beta. The beta is basically a measure of volatility of the company's stock compared to others. How volatile is it compared to other stocks? If a company pays dividends, dividends are obviously a cost of capital as well, and you can capitalize those dividends to estimate a cost of equity. Now, moving on to debt. This is something that I'm sure we're all familiar with. We're all familiar with credit cards, with car loans, with house loans. Well, the cost of debt is the same for a company, the same for a corporation. It's the form of financing where they borrow money from lenders. There can be different types of debt, secured debt, unsecured debt, etc. And basically the cost of debt is the interest rate that the company must pay. Now, borrowers that are more creditworthy, say those with a strong credit rating, will borrow money cheaper than those who are less creditworthy. So this affects the cost of debt, which in turn affects the cost of capital. So much like you as a person, when you borrow money, you will pay a higher interest rate on your credit card rather than your mortgage. It's the same for a company. So secured debt will typically attract a lower interest rate from the lenders than would, say, mezzanine debt, which is advanced to a property developer in the final stages. Now, another form of funding is known as preferred stock, or in Australia, hybrid securities. They're called this because it is in effect a hybrid of both debt funding and equity funding. Preferred stockholders received a fixed dividend payment. So it's similar to interest rate payments on debt. But they also have the benefit of being potentially able to receive capital appreciation. Now, once we have all these costs of all these different sources of funding, we can now calculate what is known as the weighted average cost of capital, WACC, W-A-C-C. Now, what this represents is the overall cost of financing the company's operations. Now, why would we calculate a weighted average cost of capital? What's the point of this? Typically in the industry, the weighted average cost of capital is commonly used as a hurdle rate in which companies and investors can gauge the desirability of a specific project or acquisition. It's inherent in their calculations. In a previous video on the time value of money, I discussed DCF, discounted cash flow analysis. Now, the weighted average cost of capital can also be used to discount those future cash flows in order to judge an investment. I'd like to point out that the cost of capital is not a fixed number. It's not a set and forget, and it can vary over time. Changes in interest rates, changes in market conditions, changes in a company's performance can all impact the cost of capital. Additionally, even within a company, there may be different costs of capital for different projects depending on their risk and return profiles. So while this has been a really quick, brief introduction to the cost of capital and to the various funding sources of a company, I hope that it's been beneficial to you, because the cost of capital is a critical concept in finance, as it represents that minimum return that the company must generate on its investments, on its operations, in order to satisfy its investors and its debtors. So by understanding the cost of the various sources of funding and how to calculate the weighted average cost of capital, students and financial professionals can make more informed decisions about how to finance a company's operations and about how to judge investments. Thank you.